Hello, friends. Today I have a very special guest to be introduced, Mr. Atul Bhole, the Senior Fund Manager from DSP Mutual Fund. Mr. Atul Bhole is the Premier Fund Manager who is managing DSP FLEXICAP Fund, DSP Equity and Bond Fund, DSP Dynamic Asset Allocation from 2016 and 2018. Prior to that, he has 10 years of experience where his immediate experiences with Tata Mutual Fund, where he was managing most of the equity funds, equity PE funds, and other things. And prior to that, he also had wonderful experience with JP Morgan as Equity Research Analyst, tracking telecom companies in the Asia Pacific region, and with State Bank of India as an Equity Research in the Treasury Department. And Mr. Atul Bhole is also has done his management studies from Jamnalal Bajaj Institute of Management, and also he is a certified chartered accountant. And with this small introduction, let me welcome Mr. Atul Bhole to the show.
Thank you. Thank you, sir. Thanks for that kind introduction.
Yes, sir.
Yeah.
And today, Mr. Atul Bhole will be answering some of my questions, which most of the investors would like to know. Okay, let me start with my first question. So, can you explain about the different investment styles, which is the growth, the value, as well as the contra, and
Okay.
how it is important in an investor's portfolio? We would like to know more
Right.
about that.
Right. Okay. So basically, these styles of investments have originated with the basic human behavior. Like every human, which is obviously a investor or a fund manager, is a human, and he will have his biases or beliefs in terms of investing into the stocks. Like we have biases towards everything in life or in day-to-day activities. So basically, in growth style of investing, the investors actually take a call on the compounding of profits of the company. Basically, we know that stock prices are slave of earning growth.
Earnings. Yeah.
So whenever companies are growing their earnings or profits consistently, and the investor take call on those consistent earnings and hence stock price appreciation in future, that is sort of growth style of investing. And when you want to follow growth style of investing, basically you have to take call whether the earnings are going to be consistently growing in the future. And for that, the basic ingredients are good management, very good business, strength of the business should be very good. There should be margin stability into the business. The return ratios like ROE, ROC should be good. So these are basic elements which are required to follow the growth style of investing or to choose companies which sort of satisfy this criteria of growth style of investing. In this kind of investing, obviously, because companies are managements are good, there is a lot of visibility and etc. The stock prices in terms of valuation, like price to earning ratio or price to book ratio, are not very cheap. They are on the higher side because everybody want to buy them because of visibility and consistency. So even despite buying those stocks at a slightly higher valuation to start with, the main call is on growth of the profits consistently over a period of time, or typically stretching into say 5 year, 10 year, 20 years, etc. So that is basically growth style of investing. This is relatively stable kind of sort of output this kind of investing gives because of the basic companies or the underlying companies are basically stable. Uh, on the contrary, if you look at the value stock style of investing, basically here the investors or fund manager want to buy a company or a stock where the market price is lower than the intrinsic value of the business. And there are various ways to calculate intrinsic value of the businesses. But generally, if you want to generalize things in terms of value investing, typically investor don't want to pay beyond say price to earning multiple of 12, 15, or he don't want to pay beyond price to book multiple of 1, 1.2, etc. uh, Now, if the company is really very good, obviously it will grow its earnings and hence it will not fall into the value bucket because in market as a whole will value it at higher multiples. So in kind of value investing, you will find typically companies which are from the commodity side of the economy, where
Yes.
there is cyclicality, there is capex involved, there is debt involved because companies need to put up big plants. and because of cycles and debt, there can be a lot of issues on the balance sheet, etc. Hence, these companies trade at lower multiples. uh, Typically, as I mentioned, growth stocks generate wealth because the profits grow up. In value category, the profits may not grow consistently because they are cyclical, and hence
Yes.
value stock don't generate return in a very consistent manner. They need some outside support, like say what has happened in last 12, 24 months,
Yeah.
COVID or war or something like that. That kind of external trigger is required for value stocks to do well. So the returns in this category can be volatile. And last, as you asked me about contra, so contra and value, there is a lot of overlap. Basically, a lot of value stock can be called as contra and vice versa. But also the other distinction between contra, or the speciality about contra, is basically there can be turnaround cases, like uh, management is not doing well in any company or business, but the business is good, but because of the management aspect is not doing well, so somebody can take a call in future, management change can happen, and hence it can do well. So something like that involves in contra investing. So I would say growth is a style where consistent return can be expected. Value is a style also, returns, good returns are generated, but one need to be very patient in terms of value investing because the returns can be very volatile.
Yeah. And do you believe that both styles should coexist in an investor's portfolio? Right?
Obviously, yeah, yeah.
Yes.
Both styles should coexist, and the because in any kind of market, at a point of time, some style can do well, and the other
Correct.
might take a back seat because the underlying
Yes.
drivers work probably differently for these both styles. So I think investors should have balanced portfolio, and at the extreme of cycles, actually they should move the money from one style to other. Like when
Yeah.
the value does very well for say 1 or 2 year,
Yes.
and we know generally the value stocks or growth stocks, so one can book trim profits in growth and put in growth value, and book in took that money into growth, and vice versa. When the growth has done very well for 3 4 years, one can take a contra call and put that money into value.
Perfect, sir. Very well answered. And coming to your investment style, I have been a fan of your FlexiCap fund and other funds also, the equity bond fund and the conservative dynamic asset allocation. Can you just throw more light on that? The core and satellite portfolio, how do you manage in a single portfolio? Like you tend to have that differentiation where you take the cycles and you create that alpha through that. Can you explain that process for the betterment of for my investors?
So, as you rightly asked, that whether investors should have growth and value or contra in his portfolio. So, in my case, my predominant bias or belief is in the growth style of investing. But as I answered, one should have a balanced approach in while constructing the portfolio. So, in my case, generally 70 80% of portfolios are growth style of investing. But
Core.
in
Okay.
20% of my portfolio, also I take calls, tactical calls, which you can call core and
Yes.
satellite strategy as you answer. So core is growth, satellite is those tactical calls where I take a call on whether the management change is happening or the sector is coming into tailwind, or sector is coming out of long period of consolidation, etc., etc. So that's the way I look at the portfolio construction. Basically, the growth, which is 80%, should ideally give me stable returns over a period of time, and this 20% where I take those tactical calls, in depending on the stock calls, obviously there can be mistakes. The This part of the portfolio hopefully gives slight alpha or add alpha to the overall portfolio return.
Wonderful, sir. Wonderful, sir. And as an advisor, we always advise on asset allocation. So, for a young investor, usually who is coming to the mutual funds, now we see that millennials coming into the mutual fund. What is the ideal mix of equity, debt, commodities, international equity they should have, and how should they should construct a portfolio? Can you throw light on that for a new investor who is coming into the market?
Yeah. So obviously, there is nothing like ideal allocation for any investor. You have to take
The
that
risk
call
profile,
uh,
yeah,
after understanding the risk profile, the risk appetite
yeah,
of that investor. Because even if somebody is young, his risk appetite or profile may not suit the aggressive style of investing or the risky style of investing. So
yeah,
ideally, anybody should have most of these asset classes at any point of time in his portfolio, and depending on the age and the risk profile and risk appetite also is very important. One can divide the portfolio. But for a typical young investor who's who's sort of his family is settled in terms of his parents are settled, he don't have responsibilities, and he has to build coffers for his home or retirement or children's education, etc. I think, and because he is young, he or she is young, his risk appetite can be higher because they can sort of get settled, get new job, etc. Even in case of something happens, ideally in such cases the equity allocation should be on the higher side, because inflation is sort of kills or takes away our savings if you don't
Correct.
invest it properly. And typically education and medical inflation is way higher than the normal inflation we experience in our day-to-day life.
Yes.
And for that, to build that corpus, I think equity investing is very important, because when you invest in equity, while you take some risk, but that risk gets rewarded over a long period of time by slightly higher return. So typical rule of thumb is basically debt. Uh, Basically, in debt, you get something slightly higher than what the government is giving you in terms of the GSEC.
Yes.
In case of equity investing, you take that risk. So for any country equity, there is a equity risk premium for that country. For India, historically it has been proven that it is 4.5 to 5%. So for on government GSEC return, one can expect this equity risk premium, and if the fund managers are good in stock selection, they can add some alpha 1 or 2%. So that's how equity can give slightly higher return than the debt portfolio, which takes care of your inflation. So I think in equity can be on the higher side. Uh, then obviously debt is there to stabilize and to take advantage of situation which can happen time to time, like we have seen drastic fall during Lehman crisis or during COVID or during Russia Ukraine war. So during such time, some money can be used from the debt to put into equity to take advantage of those falls, and then once the purpose is solved, that money can get come back again to debt.
Yes.
uh, Similarly, I think international equity can also be a part of the investor's portfolio, because obviously we know there are great companies outside India. They are sort of global companies. Uh, Genuine innovation is happening in those companies, and obviously wherever there is genuine innovation, the wealth creation can be very high. So some part of the money can be invested into those international funds or companies. And lastly, gold. So gold has not done well in last say 8 10 years, but I think gold as an asset class has its merits to be in anybody's portfolio, because the risk elements in the global financial system has gone up, geopolitical risk has gone up, and gold is going to act as an hedge against those kind of uncertainties. So gold also be probably can be a 10 15% part of the portfolio of any investor. But for a young investor, I would say equity can be a dominant part, or has to be a dominant part of that portfolio.
Yes, very well put across. And in India, you will always see that most of the investors prefer physical assets over financial assets. And mutual funds, we know, has got a solution from 1 week to 1 month to so many things, whether it is on
Yeah.
commodities, whether it is on real estate, whether it's on equities, large, mid, and debt, and everything. But our penetration levels is much, much lesser compared to the
Mhm.
overall global average. So, what is the message for the investors who are slightly above 60 years or 50 years above, who have never come into mutual funds for so many years, and how mutual funds can help them to have a financial freedom in their life? So can you throw some light on that?
Yeah, I think historically, I mean, we have seen that Indian investors or the Indian households has bias towards investing into physical assets, and two of them, particularly real estate and gold.
Gold. Yeah.
Uh, yeah, but I think gold is okay. But if you look at long-term returns of gold, they are sort of much lower than equity. I mean, really long-term returns of gold,
And if
and
you consider the dollar denominated, it will be even
dollar
more lesser. Oh,
denominated,
yeah.
it is even lesser. Correct,
Yeah.
correct.
Yes.
So I think the idea is to beat inflation over a long period of time, because as I said, the inflation really sort of takes out your savings or the component of savings. So we have to beat the inflation. Uh, how mutual fund are helpful is basically, as you said rightly, the duration is from 1 week to maybe 10 years or 15 years, one can continue invested into mutual funds. So that actually helps in wealth creation as well as provide liquidity in case there is a need to that investor, which may be very difficult in case of particularly real estate. One other thing about real estate versus mutual fund is the price discovery in real estate is very difficult in case
Yes.
there is no liquidity in that market, and sometimes it can take 1 year or 2 year to liquidate that asset, and possibly, I mean, in some cases at much lower prices than earlier thought. So I think mutual fund liquidity is there, as well as the price discovery happens almost on daily basis because our NAVs get published on daily basis.
Correct. On a
So
daily
one
basis.
knows, yeah, one knows how much sort of value of his savings is there in mutual funds. So it serves purpose in these two ways. One, basically instant liquidity as well as ability to invest for short term as well as long term. So I think that way mutual fund deserves a place into the portfolios of investors, and I think that is that change has already started to
Changes
happen.
started. Yeah, correct.
Yeah.
That's right. And one final message which you would like to give it to my investor community at large. It could be a general message, or as a fund manager, what you would like my investors to be known for, to be.
Yeah. So basically, the message is same. Basically, one has two, three message I would say.
Okay.
While equity investing is very important in terms of whether one can invest directly also, but that is not advisable because we add or we try to add a lot of value by doing thorough research, adjusting the portfolio risk reward, etc., etc. So I think one can stay invested into mutual fund and continue to invest through systematic investment plan, which is very important. Because
Correct.
what is important in equity market or in general in life is to manage the behavior of greed and cycle. Typically, when everything greed and fear. So when typically things are going very good, markets are going up, or everything good is happening, people have tendency to go overboard and invest more or go after that thing, and generally then the cycle turns. While in terms of episodes of fear like Lehman or COVID or war, people generally run away from the market, and that's the time actually one has to invest. I'm sure many of the audience would be aware of the famous sentence by Warren Buffett that when everybody is greedy, be fearful, and when
Helpful.
everybody is fearful, be greedy.
Big reading.
So
Yes.
actually, that is the way to make wealth from the market, and I think mutual fund provide that access to retail investors at large to invest that their money into the markets. So one has to sort of take advantage of this. And as I said, I mean, and you have also asked rightly many times that equity should be a bigger part of portfolio, particularly for a young investor, because uh, the two kind of services, medical and education, I think the costs are going up
Inflation
very
side.
rapidly. Everybody is aware of that, and to build coffers for those kind of needs as well as other needs like holiday or home buying, etc. I think mutual fund can be used in a very good way, systematic way, through with the timely help from the advisors, etc. So I think that's the I mean, uh, investing is no rocket science actually. Just one need to manage their behavior and be disciplined in their investing. So that's the thing I want to say lastly.
Wonderful, sir. And let
Thank
me
you.
also thank DSP team for bringing in data in a very crisp format like Tatva, Netra, and other research tools, which is
Yeah,
helping us to navigate the market easier and to understand the trends, and also get the all the market information in a very crisp way. And thank you
sure.
very much for joining us today. And it's a pleasure to have you on the show. And we look forward to have more such sessions in the future.
My
Thank you very
pleasure
much.
also.
Dr. Bhole.
Thanks a lot for this opportunity. Thank you.